is what it trades at. Let me bring on board Amit Upalenchwar, who is the director at Kalpataru Projects, joining us this afternoon to give us a perspective of how he's viewing the business. Amit, first off, on West Asia and on commodity costs, weighing down on your numbers at all, say Q4 or Q1, is that a risk from a near-term perspective?
So thanks, Harsh, for having me. Our commodity... Hello, can you hear me?
Great having you, Amit. Yes, very much. Loud and
Thanks.
clear.
So West Asia crisis, commodity standpoint, to answer your question, impact, no. Because, we've got 90% of our commodities, whether it's copper, aluminium, zinc, hedged. Steel price, we've anticipated some, and we've built that in our budgets when we, guided the PBT for the year. What did affect us in Q4 was the supply chain disruption because of the West Asia crisis. I probably lost close to 250-300 crores of revenue because my supplies could not get delivered on time. However, that got normalized will get normalized in Q1. So all in all, a very little impact to us because of the crisis as of today.
An order book, is that at all a drag, or are you more bullish on the order book post maybe a resolution, if at all that were to play through?
So as you mentioned, 31st March closing, we're already sitting at 65,400 crores of order book, which is, almost 2.5 times our revenue in the future. I think the order book, be it T&D, be it, building and factories, be it urban infra, and be it oil and gas, look very, very robust for us, both in India and overseas. Sometimes, BNF used to be a small segment for us 10 years ago. And now, BNF comprises of everything from data centers to industrial plants, material handling systems, and industrial facilities. So, so it all sort of gets clubbed under. So it's not just buildings. And when I say from the context of growth, private sector capex in India is, has picked up significantly. So we see a lot of tailwind there for us. Real estate sector remains to be resilient, be it institutional as well as residential. The airport sector is growing. Today, India, people are talking about a 80 megawatt data center as a standard product mix, right? It's insane. It's a very, very large data center, and we are going to have multiple ones coming. And we certainly hope to have a piece of that action too. Oil and gas, there are two kinds of oil and gas. So one, there is a rebuild of existing brownfield facilities that exist in the Middle East because of the West Asia crisis. And there is a reshifting of supply chain. So people are building new pipelines. People are expanding their plant capacities, certain members leaving OPEC, etc. There's a whole new oil and gas world, and hence a lot of projects, some of them publicly being announced. UAE announced $58 billion of capex in oil and gas over the next 3 years. Saudi Aramco is looking at similar numbers. Kuwait wants to rebuild. So we are very bullish in the oil and gas. Let's see how we translate that into order book and revenue for us at Kalpataru.
Metros, so tell us a little bit about that.
All over, metros in every city in India getting built. We've got metros coming now, in the Balkans, etc. We are looking at taking our water business overseas. Urban infra overseas, data centers. We are looking at solar EPC outside of India, and we see opportunity there as well. So not really overtly worried on order book.
No, maybe my question was framed incorrectly. More from a West Asia standpoint. You spoke about oil and gas, right? More from a West Asia standpoint. Are you seeing a bit of a drag with regard to orders coming in from there for the moment, and do you expect that will unwind if at all a situation were to improve or a resolution were to come at play? Will there be a significant increase? Both your T&D margins as well as your oil and gas margins, my understanding is, are better when it comes from the Middle East.
Yes. So, a lot of engagement is happening as we speak, both in T&D as well as oil and gas from our clients with us and our teams regarding projects and opportunities. Let us see how they translate, but I do not see any crisis from West Asia denting our order book prospects in the Middle East. On the contrary, I think we have an opportunity for them to get fast-tracked, if nothing else, in the upcoming quarters.
Let me stick to order book, therefore. what is the kind of order book accretion you are expecting in FY27, if at all there's a resolution or otherwise? And what's the kind of execution run rate that you're expecting will play out in FY27? So what will your total order book sit at?
So, we are at 65,400 closing 31st March. We've got close to 1,800 crores worth of orders so far. We are sitting at around 3,200 L1, so it's around 5,000, let's say, so far. And we are hoping to get another 25,000 odd crores worth of orders for the remaining part of the year. And if we grow at 15%, which means on the current 27,000 crores plus revenue, I am looking at a 15% growth rate this year. So you're looking at around 30,000 plus crores of revenue. And if I add to my 65,000 crores plus, I add another 30,000, so 95,000. I will still be between 65 and 70,000 crores of closing order book end of this year, if it all goes as per plan.
Excellent. I'm going to take a small pause on this show, Amit, and going to come back to you. There's plenty to unpack here, viewers. Stay with us here on ET Now. We'll come back, speak about margins. Welcome back, and plenty of things to unpack. One is you've gotten guidance. 15% growth is the guidance that Amit has given us for FY27. At least we'll take that. I don't want to talk far beyond that, but my guess is 15% even going forward, even beyond that, is something we can pencil in, right, Amit, in terms of growth rate?
Yes, hopefully.
Okay, and Amit, now coming very quickly to margins, right? There is a tilt or there is a preference for higher margin projects which you're bidding for. Talk to us about the more, the high interest areas currently in the market, the likes of a data center. Are margins there materially better than your regular margins in the BNF, which is factory and building segment? Is data center truly better in terms of margins? What are the other better margin areas, and how are you trying to improve margins from the current 8.5% odd? I'll talk about your subsidiaries in just a while, but just purely on the basis of your book.
So Harsh, I will talk about margins, but I will focus on PBT rather than EBITDA. What you mentioned earlier, in your when you were talking about our company a little while earlier, is because we are a very diversified organization in terms of our. But we've taken all of those hits in FY26. So going forward in FY27, we have zero hit coming as a result of our Brazil operations on our balance sheet in FY27.
Can I was slightly distracted to try and compute your current margin. What is your guidance for FY27 PBT margin?
So FY27 at the console level, we should be looking at close to 6%. Between 5.8.
Close to 6.
Yes.
Understood. And how much is the Brazil impact on your console PBT margins in the current year?
So, we cannot look at Brazil as a standalone because we also have certain incomes coming in our consolidated balance sheet. We have had, sell some of our non-core assets, etc. So because of that, yes, we've had to book a loss of close to 500 crores in our Brazilian subsidiary. But that was last year and it's all taken out now. So we have nothing of that coming or in any shape or form in FY27.
Got it. And that was the other PBT impact which happened. So this unwind which will happen to around 6%, do you believe that that's sustainable going forward as well, or can you improve on that? And what will the levers be to get you to 6 or 6+%?
So I think if you look at our sector in general, at a large diversified company with, there are cyclical natures of businesses. I think if we are able to deliver at a PBT level between 5.8 to 6 thereabouts is a very, very good PBT margin to sustain. So we do not want to have 1 year show a dip. A good thing with us is that we've always kept balance sheet as our focus and deliver consistent numbers. And I think if we can deliver 6%, we will obviously always try to improve our margins as we go forward. But I think that's a good number to have at a PBT level for an organization at this scale.
Okay. Plenty of levers from a monetization perspective as well. So one of those will be further assets which you will look to monetize. what's the quantum of asset base that you will look to monetize, especially in that boot portfolio that you have, and any other assets that you're looking to monetize?
So Harsh, we had 8 boot portfolios a couple of years ago. We are left with one, which is running its course and should finish its concession cycle in the next 24 to 30 months, post which, and which is a profitable asset, we have no debt on it. At the end of this cycle, we will have no boot asset left. Even now, the debt on our entire boot portfolio happens to be zero. We have only one asset other than our operating subsidiaries, so I won't call them as non-core, which is our logistics company. And the objective is this year we are going to retire all external debt at Shubham Logistics, which means it will be external debt free at the end of the year. And hopefully the only thing left for us to do is, if we get a fair price in the next 24, 36 months, to see how we can divest that asset as well. But other than that, we have no other non-operating, non-core asset left in FY27.
Amit, what would be the approximate value of all of this combined? And I'm only asking you for a ballpark. I'm not getting into individual assets, and I know that can be sensitive. So what's the ballpark number one can work with?
Harsh, I'm unable to give you that number because we just have one asset. And that's, like I said, our boot asset is going to run its course. It's already debt free. So we will just have Shubham Logistics, which is left as a part of this. The others are all operating businesses, and hence those subsidiaries are required for us to do business in various international markets. So, we are not, they are a core to our business. So I don't know what value I can assign to Shubham. I think we'll have to wait and see how that business pans out over the next, 2 fiscal years. And then I'll be able to give you a better idea.
Sure. Some possible value unlocking. One from Sweden, likely. One is your domestic manufacturing unit, which you could also consider. Any others in terms of considerations on the table as value unlocking opportunities which you're considering?
Honestly speaking, yes, there are, we are looking at various opportunities to unlock Sweden. We'll use that money to grow the organization. We still are a little far away, so I cannot give you any valuation numbers there because we still don't know in which form we're going to raise a capital for the growth of that business. Manufacturing, as of today, happens to be an integral part of our business, which helps us give sustained and reliable delivery across the value chain of EPC. So right now, there is no plan to spin it off or, list it separately or unlock value. So right now, it stays pretty much a very integral part of our business.
You sit on a large cash balance, Amit. You also have a very good free cash flow pipeline, which is likely to come through next year. What's the capex plan like, and what do you intend to do with the very large cash that you hold? Will you keep it for the purposes of execution? Will you use it for debt repayment? How does it play out?
So, we'll be happy to use that cash for debt, but, we've been very fortunate and the team has delivered excellent results, as a result of which our debt is pretty much next to zero at 700-800 crores on standalone basis. We want to use this money to build capability. We are looking at, first we had RPA, which was process automation, which then moved very quickly to Gen AI. And now we are talking about agentic AI. We are spending a lot of money on building the tech capability of our company to be able to deliver more sustainable and more mechanized outcomes for our EPC projects. We are looking at building higher value projects in terms of order sizes going to 1,000, 1,500, 2,000 crores per project, which will require for us to build capability in terms of people, building our engineering capability from where we are to take it out even further. We may look at, certain companies that we may acquire in order to boost our presence of our existing sectors, either overseas or go in terms of complexity. We already have a very large center of excellence, which has 600 to 800 design engineers. And I think we want to build on that to build capability. From a capex standpoint, I think we are looking at 800 odd crores this year because we are looking at further expansion of our manufacturing business. We are looking at adding some strategic facilities in order to further backward integrate our manufacturing. And so as of now, we are at 800 crores, and towards the end of H1, we may come back to you if we are going to increase that capex if these projects start materializing the way we look at them today.
Okay. Amit, thank you so much for coming in and speaking to us. This is complete pleasure, but I'm absolutely out of time on this edition of the show, viewers. Stay with us, more action to follow. Thanks so much for watching.